for years, especially when we started Thinkorswim, some of my really good friends partnered up with us. They partnered up with us and built technology with us. And they were prop traders. But in today's world, we call them high frequency traders. But in back then, they were just prop traders, but they were professional prop traders. They were a market making firm that would internalize order flow. Now, a few different times over the course of a 10-year period, we tried to do a deal and buy their firm. Every time we tried to do a deal and buy their firm, we would bring in a investment banker. Every time we bought a smart investment banker just to help us facilitate the deal. Every time we tried to write up the deal itself, we couldn't describe their model. Mm-hmm. The reason we couldn't describe their model was because it changed every 3 months.
Exactly. The market has, in machine learning, you have something called concept drift. Yeah. The market is constantly adapting.
These were the most brilliant traders ever, and they did not know what their business would be like 3 months later. And I call them brilliant because they were able to solve the mathematical problems that nobody else could solve, and so they were ahead of the curve. Mm. But nobody could even articulate or write up what their business was, including them. Because they say, this is what we do today.
Yeah.
And then 3 months later, this is what we did 3 months ago, and this is what we do today. And it was the exact opposite.
Market changed.
Market moved. Mm-hmm, mm-hmm, mm-hmm. And regulations moved, markets moved, mm-hmm. The business moved. And then 3 months later, they would change again. And today, they are still one of the most profitable firms in the whole industry. Sure. And they've probably changed their business 200 times. And it's just, and the reason is because they understand this. They're constantly moving the technology forward, and they understand that what they did just even last month doesn't work anymore.
It means nothing. It was a good sales pitch. It means nothing.
It was the most fascinating process because I'm telling you, we couldn't even articulate their business. We couldn't even write it on paper.
I can't tell you what the price of milk is going to be a year from now, but I can probably tell you with a pretty high probability what it's going to be 1 minute from now. Same with stocks. I don't know what it is tomorrow, but probably in the next 10 seconds, probably better probability.
I thought that machine learning and AI would help us to predict the markets, but actually it's done something far more important than that. It's helped us to see with empirical evidence to validate the market's true nature. Let's begin. So in this video, we're going to take a whole array of indicators, RSI, MACD, CCI, price, volume, etc. And we are going to try to predict what tomorrow will do in the S&P 500. Just, will it be up or will it be down? Will the close of tomorrow be up on today or will it be down? If you could predict that with any decent degree of certainty, you would do extraordinarily well in the markets. Now, this sounds simple enough, but there's a lot of lessons that we have to learn. And in this video, you're going to see a lot of things failing. However, this is going to be gold for those of you who are interested in machine learning and deep learning and want to understand how to apply machine learning and deep learning to the markets. I had to go through months of learning and trial and error to figure things out. And you're going to see all of that over here. And I'll probably put the code in the members section of Crypto Wizards as well. We're trying to predict something very, very simple. I'm not trying to predict what's going to happen months out from now or weeks out from now, even days out from now. I just want to know, hey, what's tomorrow going to be? I'm going to give this model 20 years of data of the SPY or the ETF trust of the S&P 500. Just think of that as the US market for those of you who aren't too familiar with indexes, etc. I'm going to give it 20 years of daily data and just tell it, predict tomorrow. And I'm going to take you through the LSTM, artificial brain. You're actually going to see, and by the way, if you're not into programming or you've never seen a computer learn by itself, you're actually going to see that here in this video. I'm going to take you through another way of doing it, a faster way using something called a convolutional neural network. And then we're going to get into XGBOOST, which is essentially a very, very useful algorithm. It's been known for winning a lot of competitions at Kaggle for data scientists, etc. If you don't know what Kaggle is, don't worry. Just know that this thing is really powerful. And actually, it's been the underlying machine learning algo that has supported the good stuff that I've been able to find in the market, which we're going to review in the next video. So the first thing here is we're going to use this LSTM. This is a long short-term memory neural network. And I'm not going to go into so much what makes this particular network special, but just bear in mind that it's very good at remembering sequences. So what I'd like to show you is how an artificial brain works. How does a neural network, a computer neural network or deep learning, how does that actually work? And that's what I'm going to draw up for you very badly on the screen right now. But I want to explain this just very quickly for any folk who aren't familiar with how a machine learns, because it's fascinating and it's actually taught me a lot about our own brains and how we work. So essentially, we're going to have two inputs into an artificial brain for this particular model. We're going to put in the close price of the S&P 500, and we're going to put in the volume of the S&P 500. And remember back to the last video, and if you haven't watched that, I highly recommend just watch this playlist. I've put a link for the playlist in the description. Watch this playlist, watch the first video. It's very important that you understand why we're going about this the way we are. And it's also going to teach you a lot about the pitfalls in trading that really this is just empirical evidence for. So it's very, very valuable for you. So if you haven't seen that, go watch that. But we're going to feed in the return of the close price, and we're going to feed in the return of the volume. And there's different ways we can think about the return of the close and the volume. Here, I'm just going to take today's close and divide it by yesterday. That'll give me 1 point something if the close went up, or 0 point something if the close went down. And what we're going to do is feed in a sequence. So let's say the last 10 days, we had a day that was up, we had a day that was down, we had a day that was down, we had a day that was really down, we had a day that was up. And let's just say, in fact, here, I don't want to draw more arrows. So let's just say we're going to feed it in these 5 sequences here. And I'm going to say, okay, model, predict for me whether tomorrow will be up or down based on these sequences. And I'm going to tell it to predict the close. So I'm going to say, just predict this area here. That right now is what I care about, is that close. And the other thing I'm going to feed it is the volume as well. Now, by the way, I've tried this with open, high, low, close, volume indicators, etc., etc., etc. You can feed in a lot of things into this. And actually, one of the biggest challenges for me was learning how to shape data to fit it into neural nets. Believe it or not, that's very poorly explained online. So newbies like me found that very difficult. But nonetheless, we worked it out. So we're going to feed this into the neural network. So where's the network? Well, just picture a few more neurons here. And when I say neurons, I literally think the best way to explain how this works is for you to think of your own brain. You've got connections in your brain. And so what we're going to do is connect these two inputs. These inputs could be smell and taste. Here it's the close price and the volume. So these are each connected to this what's called a hidden layer, and to these artificial neurons over here. And what this model is essentially going to do, and it depends how many layers we put in, but it's essentially going to work out what connections it should strengthen and what connections it should not. So that's going to be connected as well. And rather than drawing all these connections right now, you'll be here forever, I'm just going to draw a big squiggly line, just showing that those are all connected. Then we're going to have an output layer. And I'm going to go back talking about those connections in a minute, so you understand what I meant by that. This is going to be our output layer. And so this part over here. Is the market going to be up or down tomorrow? That's what I want this layer to predict for me. So very interesting. So these are all connected here to this output layer. And what we want this model to do is say, okay, this brain connection here, or computer connection through code, but think of it as your brain, like a literal connection in your brain. I want this to strengthen. I want this to get really strong, and I want this to get strong, and then I want this to here to get strong, and the same with this. So it's basically going to find connections that are very strong, that work, and then it's going to double down on those essentially, or tweak them depending on if they continue to work or not. And this is called deep learning. So how do these connections know to strengthen? Well, there's something called backpropagation. So what happens is we train this model on a training set of data. So we take the 20 years of the S&P 500 data that we're going to train off of, and we say, okay, let's take 70% of that data and train it, and then whatever it's learned, test it on the data that it hasn't seen, and see if it was able to do that sufficiently. And so during this training, it just repeats the cycle over and over and over again. And so what it does is it calculates over here, think of it as a loss. And in fact, that's what it's actually called. And it calculates a loss, and then it decides how it should apply a correction to all of these connections in its brain, what we call weights. These are actually called weights. So how does it want to apply that learning to those weights? And so it applies that. It's just like you think it's a good idea to go and kick someone in the leg when you're a kid, and they react badly to you, and you learn there and then, oh, kicking someone in the leg, not a good idea. I don't think I went around kicking people in the leg. Don't ask me where that came from. But it's the same. You're looking for rewards. And so what we do is we incentivize just through maths, just through saying, hey, I want you to achieve as high a number, as good a result, or as low a loss as possible. We incentivize this neural network to do that. So it's not actually looking for an incentive. It's just mathematically told, hey, make this as strong as possible. And so that's exactly what's going on here. So I'm going to remove this neural network now from the screen. We're actually going to go and run this. But everything I just explained, by the way, and I used Keras for those of you who are into your programming. I used Keras for the LSTM, and I actually used it for the others as well, because actually I found it a lot faster, a lot easier to put together. And for LSTMs, there was more documentation. It was easier to do for a newbie. This here is the neural network. Believe it or not, this is all the code needed to build an actual artificial brain. The rest of the code is really around structuring the data, etc. So right now we're in Jupyter Notebooks. And by the way, if you guys think I should do a course on programming, I'm really thinking about doing it because you know I love teaching anyway. We're in this thing called Jupyter Notebook. So every time I hit Shift and Enter, it's going to run a particular cell. Right now, all it's done is it's imported some packages that we need. And now it's just basically about to pull a ton of data. So I'm not going to explain everything that's going on here right now. You don't need to know. Essentially, what it's just done is pulled 20 years of data. So from the 1st of Jan in the year 2000 all the way to the 29th of May 2020. And now what we want to do is say, okay, I want you just to take the close and volume of that data. I want you to calculate the log of that data. And here, actually, instead of doing divide by, we're going to work out differencing. So I'm just subtracting yesterday from today. And that's essentially what I'm going to do now. And now what I want to do is essentially calculate whether the day went up or down, the sequence went up or down. And I'm just going to skip past here a bit. So this is a chart of the S&P 500's close price from a returns point of view. And this is a chart of its volume from a returns or a differencing. Actually, I shouldn't say returns. Here we actually use differencing. It really doesn't matter. I could have just made this divide by. But what this is essentially doing is it's just looking at the change from yesterday to today, and it's looking at it on a log scale, getting rid of any magnitude kind of noise. It's very important for machine learning models that the data is, what's called normalized, etc. And so what we've done here as well is we've also done min-max scaling. So we've also made sure that the close price can only be values between 0 and 1. And that's still fine for the neural network. Just think of it as another way of encoding the language. Think of it as you see a stock chart and that's your English, but the neural network only understands French. So you need to translate it into French. Think of it that way. Otherwise, if you give it English, it's going to be like, I think I know what you're saying, but not quite. So what we're going to do here is just calculate the shape of the data. So this is very interesting. So what we're looking at now are sequences of the close price. So you can see here's a sequence here, here's a sequence here, etc. But essentially these are the close prices here, the sequence of the close prices. Here are the sequence of the volume features that we're wanting to give the model. And then I'm saying, okay, so the next day essentially was up. We went from 0.429 to 0.493. And so this 0.429 ends up there, 0.493 ends up there, 493, then the next round of data, there's the 429. So what it's doing is just chunking that data into sequences of 10 days, 10 days, 10 days, 10 days, 10 days. What happened the next day? Was it 0 or 1? Was it up or down? And so that's what we're doing. And so these are called your X variables that we're feeding in. And these 1s and 0s here are your Y variables. This is what I'm going to tell the model to predict. Anyway, what we're going to do now is just check the shape of this data. You don't need to know much about what's happening there. And now we're going to run our neural network. So we're going to build our model. And so it's building the model now for us in code. And that's taking a little bit of thinking. So we'll just give it some time. So here it is. We've got our first layer over here. Then we've got something called dropout. So this just makes sure that the model doesn't try to be too perfect. It doesn't do what's called overfitting with the data, which again is for another day. And now we've got these other layers, these other hidden layers that we drew earlier in the video. So now what we want to do is actually go and fit the model. And this means it's actually about to learn. So I was really excited when I first learned about this. And I didn't sleep for like 3 days. I did about, 5 Udemy courses in a week as well. I was having caffeine at the time, which I don't really sleep well when I have caffeine. I love coffee, so it's unfortunate. But I got really excited to see what you're about to see. So we're just going to hit Shift and Enter. And what it's going to start doing is actually training that model. So where you're seeing this arrow moving forward and you see this loss reducing, you can see here it was 5.1, now it's 5.0, 5.1, 3.9, 6.9, 3.9, 6.0, 5.2. This model was actually learning, and every time it was making mistakes, it was trying to correct itself as well, which is just super interesting and super cool. So we've only run this for 10 epochs. So this means we told it to go through essentially the cycle 10 times. And now we're just going to have a look at some data on a graph. I'm not really going to go into this because it's actually not that interesting. And in fact, it tells me the model's pretty weak. And now what I want to do is see what it actually predicted. So now this is very interesting. And not only did I tell it what to predict, it said, tell me the probability of what you're going to predict is going to happen. So tell me the probability of a 1. And here it's saying there's a 53% chance. In other words, it's a 1, 53, 53. These numbers are all slightly different, but a very, very, very disappointing result. And I looked at this and I thought, oh my word, this is the same 53. And hold on in your mind, hold on to this number here, 53. It's really interesting. Hold on to this number in your mind because you're going to see this a lot. And it's really important that you understand this number. In fact, theoretically, this model was very, very successful in many ways. Nonetheless, we've had an artificial brain go through 20 years of data, and it's given me what looks to be a 3 to 3.5% edge. 3% edge, right? 53%. Now, for those of you who saw the previous video, and I'm just going to bring it up very quickly, having just a 1% edge helps us out dramatically. Let's say we have $100 and we want to turn that to $200. Having a 1% edge, if over enough trades, we actually have a 98% chance of doing that. This is why the casino always wins. It's got that 1% edge. If I have a 2% edge, or in this case, a 3% edge, it's a certainty. So a lot of you might have seen this and said, oh, this looks great. That's a fantastic result. But why is it predicting every day is going to be up? So now we're looking at the S&P 500. And if we zoom out over many, many, many years, what's happened with the S&P 500? Well, it's moved up. So we've had more up returns than we've had down returns. In fact, about 3% of the time, the market will be up more than it will be down in terms of positive or negative. Now, that said, the markets don't crash upwards. The markets only crash downwards. Look at this recent crash we had here, right, on the S&P 500. The reds, the magnitude of the reds, tend to be far greater than the magnitudes of the greens. So even though we have more up days and theoretically that's your edge, just bet every day is going to be up. And you'll be done. You've got your 4% edge. Well, that makes an assumption that the market will continue to always go up, which it might not. And also from a returns perspective, when it goes down bad. So it really does cancel out, I would say, to be a 50-50 distribution. So a 53 or 54% result here in this model is no good to me. It's no good. Betting every day up, it's just gambling. You are not the casino. You are still attending in the casino because remember, you got your broker fees as well. So even if it's 50-50, when you're paying a bid-ask spread and you've got your broker fees, etc., you are negative 50%. And remember, if we go back to our probability math calculation over here, if you have, let's say $100 you're starting with, and you have a 1% edge against you, 1% not in your favor, you only have a 1.83% chance of actually doubling your money. That's the actual probability because of what's called a random walk. So very interesting, not good enough. Anyhow, we spent quite a lot of time on this first model. There are some far more interesting things to show you. Just very quickly, we did the same thing here with a convolutional neural network. So for those of you, and I just wanted to show this for those of you who are building LSTMs or interested in deep learning, just maybe pause the screen or take a screenshot or just tell me if you want the code on the members section of Crypto Wizards and I'll put it there for you gladly. And you can just take this code over here. This is really helpful because actually it gets pretty much the same accuracy and it's like 100 times quicker. It's actually using the same process that these artificial AIs that we see for image recognition, something that, for example, your phone that recognizes your face, it actually uses convolutional neural networks to do image detection. And we've actually used that to detect sequences, which is what the LSTM does. So a little bit of geeking out there, but I'm going to move on now to XGBOOST. So before I get into this, one of the things I tried, and rather than running all of this for you right now, I'm just going to sort of go through what happened. If you remember XGBOOST, we've been able to, or essentially what you're able to do with XGBOOST is feed it with a bunch of data and get it to also predict things like, will tomorrow be up or down, or what will my house price be given a bunch of factors like the location or the square foot size and all of those combined. And it's actually my favorite machine learning model to use. And I've used it both for regression, in other words, predicting values, and classification, i.e. is it going to be a dog or a cat? Is it going to be up or down, etc. And so it's an enormously powerful model. And what I realized going through this XGBOOST is that, and I had made a mistake in the coding, and I'm going to tell you the mistake I made right now. I had accidentally, so if I look at my data set, where I've got all my close prices here, I had accidentally also included tomorrow's volume. And I didn't realize I had done this. And it's so easy to make these mistakes with these models. Believe me, it's so easy to get something wrong, which is why it took so long to post these videos. I had to check myself over so many times, and I had made so many mistakes. Because it knew what the return on tomorrow's volume would be, it gave me near a 60%, I think it was about 58%, but a 60% probability factor, which is huge. That's a 6% edge, because if the S&P 500 has been, 3 to 4%, it's up every day, then we have a 6% edge if we can predict something with 60%. This is a big number. It might not sound like a lot to you, but if you understand options trading, this would have been a huge deal. And so I was getting really excited. I couldn't work out what was going on. And I found out it was actually the volume, tomorrow's volume, rather than the return on yesterday, that I had calculated. And that taught me something. That said that, hey, if you can predict volume to a good degree, then you can actually predict whether tomorrow's close price will be up or down. And so to me, this was absolutely fascinating. So in this neural network over here, which actually, why not? Let's clear this and actually run this together. What I decided to do was take a convolutional neural network, artificial brain, try to predict the volume, and then see if I could feed that predicted volume into the XGBOOST model to then give me like maybe 58 or 56%, like a real 3% edge. And lo and behold, this is what happens. So let's go through this again. So I just had to clear my screen. I had a few buggy things going on. So we're going to run this neural net now. And I'm just going to kind of race through this a little bit, just because I want to get to some of the good stuff with all the indicators that we had tested. And I want to show you all the kind of models that I've gone and built. But we're going to train this model now. So this is using a convolutional neural network. And remember, what we're doing is we're essentially doing this process here. We're trying to say, look, neural network, I'm going to give you the close price and I'm going to give you the volume. And I want you to put it into these hidden layers that we saw earlier here. And I want you to spit out whether the volume is going to be up or down tomorrow, essentially. Or in fact, rather than spitting out whether the volume will be up or down tomorrow, just give me what you think the volume will be in machine learning terms, in French, not English. And that's essentially what we're asking it to do over here. And so we're hoping that once we have this, we can feed all these results into a data table of our close returns, our volume returns, and our predicted returns over here. That's essentially what we're looking to do. And you can see this arrow moving over here. And the reason for that is because this model's still learning. I told it to run 350 times. It's way overkill. It actually could have stopped round about, I know because I know what loss this gets to. It could have stopped round about here at about 170 goes. But anyway, it's still going. It's hit the 350, sorry. And it's hit a loss of 0.0518. Now, if I scroll down and I say, okay, now go and take this model and make predictions over the whole data set, not just the test section. Because remember, with machine learning, you always want to do this. You don't want to ever give a model all of your data up front to learn from, because it will overfit that data. What you want to do is slice that data up and give it this much of that data to learn from, and then say, okay, go and test this much of your data. And actually, when we did XGBOOST, we sliced this up many different ways using something called KFold Crossvalidation for our predictions, just to get that real accuracy and make sure it's done very well. Otherwise, the model gets so clever, it learns exactly what happens in this box, and then it's useless for looking into the future to make any predictions. So that's essentially what we're doing now, is saying, okay, let's actually now test it, but rather than testing it just on the test, make the predictions over the whole data set and use that to help train the XGBOOST model, which is a new machine learning model that we're going to go into here. And so the star here just means it's still calculating, and it shouldn't take too long. There it is. And here's all my, in the French language, you can think of it as, or the machine's language, the volume predictions. And so over here, what we want to do is just go and see if that all worked. So here's close and volume. And now what we want to do, I can ignore that error over there, is put these predictions in, and that's what we've done. We've got close, volume, and predictions. We're going to see a few errors pop up here. I've looked into the data. It's actually fine. I won't get into what those really mean right now. So here's the real outcome. We've got 0, 0, 0, 1, 0. And if I actually said, show us maybe 20 results in this data, we can see some ones and we can see some zeros. So this is the actual outcome of whether the close was up or down. So here you can see tomorrow's close was 0. So this is 0. Here's a close of 1. So the day before says 1. And so what the machine learning model is going to do, XGBOOST in this case, is try and use this to train itself, again, taking a slice of the data and test whether it can predict the close now that we've predicted tomorrow's volume with the deep learning model. So again, we've taken here, just in case because I'm going pretty fast because there's so much to cover in this video, but we've essentially done this. We've said, okay, let's take close and volume, and let's now predict tomorrow's volume. So I'm going to do volume with an arrow just to say the predicted volume. And we did this using the neural network. And now we're saying, right, let's feed all of this into XGBOOST, which is an extraordinarily great machine learning model responsible for winning, again, a lot of Kaggle competitions. So let's feed it into XGBOOST and see if that can predict whether tomorrow's close will be up or down. Okay, we've got a lot of people online saying they can predict tomorrow what's going to happen, what they think is going to happen, etc. We've given a machine learning and AI model 20 years of data with sequences and told it to run over that 350 times using mathematical precision. Okay, that's what we've done. This is the extent of effort we're going to over here. So let's see what actually happens when we pull this together. So these are the features. We've got a close, a volume, predictions, and we're going to try and predict the outcome. And so what I'm going to do over here is train the model. So we've just trained the XGBOOST, and now we're going to see essentially how well it performed. And you don't really need to worry about all these things I'm doing here right now, but I just want to see what this accuracy looks like. And I haven't done this bit with KFold Crossvalidation, but I just wanted to show you that it's actually given me a worse outcome. Look at this. This is shocking. It's giving me worse than had I just predicted every day is going to be up. If I predicted every day was going to be up, I would have done okay. Taking aside the fact that the down days are much stronger. And from an options point of view, that may or may not have an impact depending on what strategy you traded the options with. I'd have to think about that a bit more. You know, technically, because the markets went up, you should have made money if you had predicted every day being up. You should have actually come out on top. But nonetheless, past events are not indicative of future results, or past results, I should say, are not indicative of future results. And so this here is a report. Basically, it says, okay, how accurate was it predicting zeros? It was 49% accurate with zeros. How accurate was it predicting ones? It was 56% accurate predicting ones. So all of that effort really for what I would say is really no edge. And there's some other metrics in here that might concern me as well. So we've just gone through a lot. And we've used all these neural networks, we've used XGBOOST, we've used everything, and we're still not able to predict anything. And in fact, before we get into the good news in the next video, I've got some more bad news to take you through. But I think out of this whole video, this is a part you're going to find really interesting, because no doubt for anyone who's traded or been interested in trading, you've looked at indicators. And so you can see here's a lot of models and variations of things, etc., that I've tested. Also tested news classification. By the way, I'll do a video on this if you want me to, where I scraped 20 years of news data from Google. In fact, I could show you the algo that did it. It's really cool. Just a bot that went and scraped news data and worked out the sentiment and tried to make predictions. And so if you want me to do a video on that, I absolutely will. Now I want to take this XGBOOST model, this one here, predicting using a lot of indicators. And I'm going to clear everything just to make sure everything's nice and clear, and we get to run this again together. We're going to pull in price, MACD, RSI, CCI, and we're going to pull it over a heap of data, a long period of data. We're going to put in volatility, which I had to pay for. I literally paid, well, I forgot to cancel, so I actually ended up paying $200 to get the volatility data. But I've got what's called implied volatility data as well, and I looked at the change on that, and I brought that in. And then what I did was join all these data sets, calculate a bunch of other features, advances and declines, etc. What day of the week is it? Standard deviations, volume changes, log changes, just every indicator under the sun, because XGBOOST is also very useful for finding what features were actually useful at making predictions. And we ran that through XGBOOST, and we even have sequencing. I even said, now take all of these features and create time series steps for all of them. So feed in the previous time series with all these features into the XG, like literally just give this animal everything and see what it does. And lo and behold, let's go through here and see what happens. So we're putting in price, MACD, RSI, CCI, volatility, you know, all of this stuff here. And we can just go on, and you can ignore that error right now. Standard deviation, etc., etc., etc. And we just keep going. And here, what I've done it to do is just give me all the sequences. So if I look at the data set, you can see it's got log volume change, sequence 10, and it's got log volume change, I don't know, somewhere here, sequence 8, etc. Then it's got some of the columns hidden because there's so many columns that it had to hide some of them. And now what we're going to do is we're going to take this data here, and we are going to try and make some predictions. So let me just see what's going on here. Actually, what I needed to do was just to comment that out. There you go, that's better. So we've got all these columns here. Now what I want to do is actually go and train my model. So that's happened. It's so quick, it's unbelievable. And now what I want to do is go and test out the accuracy. So I'm not going to say what this is yet, because it looks really good in the next video, and it's going to be quite exciting for you guys. Excuse me. But what I want to do now is see how accurate was this model. And I'm testing it not only looking at the test data, so I've taken the training data, trained the model with all of that information, all those indicators as well. But I've also now applied it to the test data only to make sure it's legit. And now I've done it using KFold Crossvalidation. So basically I've sliced this 10 ways from Sunday, 52% accurate with a 3% standard deviation. It's worse than random, literally worse than random. And so this here tells me the feature importance. So it tells me feature 23 was the most important. And it even tells me how it made decisions. So when you're legitimately using XGBoost for certain exercises, it's really, really interesting. Now, the thing is, we got way too many features here, way too many. So what I'm going to do is uncomment this for a second here. And we're going to run this again. We're just going to restart everything. And we're going to run it straight from the top. We're just going to plow through this really quickly. And I'm going to do it step by step, but just really fast. And we've pulled in all those sequences again, but now I've just got rid of all those columns and I've only chosen a few columns, and I've said, look, just choose the important ones that you said matter, and let's see if that improves our results. So it improved our results a tiny amount, getting rid of all those features, but what does this really tell us? This tells us that it's kind of useless. These indicators are actually just confusing the model, if anything. And here I've got features 0, 2, and 1 in that order. That was the order of importance. So it actually found CCI the most useful, then the log volume change, then the log return. Really what it's saying is there is no correlation to predicting. There is no predictability based on today's results or the last 10 time steps, with indicators or without indicators. There is absolutely no predictability as to whether tomorrow is going to be up or down. Now, if we go back to this model we looked at in the last video, and again, we can just refresh this anytime we want because this is completely randomly generated. It looks like a real chart. We can see support lines, we can see resistance, etc. It's a fugazi, it's a fugazi. Did you like the clip that I put at the end of the last video? I thought it was really cool. It's not real. And so before I can show you the good stuff that I found, I really needed to take you through this so you could learn some hard truths. Trust me, like if we can give this level of detail to a machine learning algorithm and deep learning models, so machine learning models, so non-deep learning models, and deep learning machine learning models. So, deep learning is a subset of machine learning. I think I should be more accurate. 6 ways from Sunday, we've put this together, and we haven't been able to predict anything, nothing worthy of our time or attention. However, the thing is, I think this is the most valuable video of them all, because rather than knowing what doors work, we know what doors to close for good, and then we know what doors to look at to open. Take care. See you in the next one.
I've seen many systems based on artificial intelligence and, machine learning and just all these different, user-defined algorithms, and everybody claims that everything works. We all know that none of it works. But is there even a way that it could ever work? Like, I'm just trying to. So much money is spent on, the artificial side of the artificial learning side to this, but it sounds like it's not even. It should never be mathematically possible.
Well, I think it has to do with the model or the market is always adjusting. So if you have a market, if you have a model that works, it may work for a very short amount of time, and this is kind of what I studied in the past. Yeah. It may work for a very short amount of time, but then the data is going to, the parameters are going to change. People are going to spot those opportunities. The market's going to change. You need a new model to get in there and adjust.
You're exactly right. I'm going to tell you a story in a second. Let me just finish this, but we'll tell you the story in a second. But you're exactly right. I'm going to tell everybody else how I know this is